Even if you haven't been paying close attention to the news over the past year, and we wouldn't blame you, you've probably still heard of hedge funds, and particularly their battle with the online community of Reddit and the GameStop saga. It seems like anytime hedge funds are mentioned, it's all for the wrong reasons, and they are often viewed as the villains of the financial markets. From concerns about risky practices to perceptions about how they only help the rich get richer. Hedge funds are a big, moving target. But what exactly are hedge funds? Well, welcome back to the channel. I'm Mike Smith, a fund manager based in Sydney, Australia. Today's video, we're going to cover a few of the basics about hedge funds and hopefully provide you with a better understanding of what they actually do. Now, you might have heard of hedge funds before, but how much do you really know about them? Even with some curious research, they aren't exactly oversharers when it comes to their methods, so it can be hard to fully understand how they work, leaving you with questions like, who are hedge funds for? What's the difference between a mutual fund and a hedge fund? And how do hedge funds invest? So with that in mind, let's get straight into it. First up, are mutual funds like hedge funds? The short answer is no. We mustn't confuse hedge funds with mutual funds. While hedge funds might get a bad rap, the same cannot be said for mutual funds. And in Australia, these are known as managed funds. Mutual funds have become commonplace as a means with which everyday investors can gain a foothold in the market and build their wealth. However, hedge funds are often considered as a vehicle only for the sophisticated or the elite. In the US, for example, hedge funds are limited partnerships available to qualified investors who earn more than $200,000 per annum, or those who have a net worth of more than $1 million US. While in Australia, hedge funds service sophisticated investors, which requires an individual to earn more than $250,000 per annum for at least 2 years, or hold net assets of at least $2.5 million. So you can see why they get a bad rep for being elitist when the barrier for entry is so high. Now next up, how do the practices of hedge funds and managed funds compare? The practices of hedge funds and managed funds differ markedly. You'd think hedging would be all about mitigating risk. We've all heard of hedging our bets, but in fact, hedge funds are just as risky as any other fund due to the aggressive trading methods they employ to drive returns for their sophisticated clients. More specifically, hedge funds can engage in far more diverse trading activity than the likes of a mutual fund. Hedge funds can get away with this because they are not subject to the same regulations as mutual funds, and clients are deemed capable and competent in understanding the risks associated with hedge funds trading activity. There is far greater flexibility and freedom for a hedge fund to invest in assets it deems relevant to help it meet its goals, whether those assets include property, options, futures, and collectibles. Furthermore, hedge funds are also differentiated by their access to shorts and leverage, which mutual funds are often excluded from. And finally, when it comes to liquidity, hedge funds are far less liquid than funds run by their counterparts. A hedge fund may lock investors' money into the fund and prevent outflows at certain times. Although this can be beneficial in helping establish a fair price for assets with less liquidity like property or collectibles, investors carry liquidity risk as they cannot access their funds. As you can see, hedge funds have a far wider range of tools at their disposal when it comes to trading than what a managed fund does. So what strategies do they utilize? Before we find out, make sure you click the like button and subscribe to the channel if you're looking for more finance related content. So back to where we left off. What strategies do hedge funds use to invest? There are 4 key strategies we're going to explore that hedge funds commonly utilize. They are long short, arbitrage, event-driven, and market-neutral. First up, the long-short strategy. This involves investing long in one area and then going short in another. Now, going short or shorting is where you effectively bet on the share price falling and profit in the process. Now, for example, a hedge fund might go long in shares of Bank of America and at the same time hold a short position against, say, Citibank in order to take an opposing view that Bank of America will outperform the likes of Citibank. Next is a favorite amongst hedge funds, the arbitrage strategy. This is where a hedge fund seeks to profit from errors, or more so discrepancies in the prices of the same or near identical securities traded across different markets. This is often achieved with high frequency algorithms that everyday investors can't access. Next up, the strategy that relies on trading expected news flow is the event-driven strategy. For example, a hedge fund manager might make a trade in anticipation of an announcement by a company, or they might go long or short in response to an event. This could include mergers and acquisitions activity, sales updates, macroeconomic factors, or even a bankruptcy announcement. And finally, there is the market neutral strategy. This type of strategy is more attuned to the inherent practice of hedging risk. It strives to eliminate overall market risk by driving returns from individual positions in assets like stocks, rather than relying on macro forces. Now, as we've seen, hedge funds have a wide range of strategies and tools they can employ. So the question everyone wants to know is, do they outperform other funds? With all the advantages they have, you'd think they would outperform a managed fund, but this isn't always the case. Hedge funds might be lucrative, but they haven't always beaten mutual funds. This is complicated by the fact that hedge funds don't always share the same performance benchmarks, nor disclosures, so it's often easier to get away with underperforming. While leverage and expertise can help drive superior returns, there's no assurances given the risks that are involved. In fact, things can blow up massively, as we witnessed in 2021, when the Archegos fund collapsed and cost investors billions of dollars. There was also the infamous battle between Reddit investors and hedge funds when the latter tried to short GameStop, only for their positions to be squeezed mysteriously. These aren't isolated examples, and simply highlight the dangers of the risky trading practices among hedge funds. Despite these risks, it can be argued they do have a place in the market. Not only does their shorting activity help keep stock prices near intrinsic value, but they also exploit price inefficiencies to achieve price discovery and boost overall market liquidity. These are all positives that investors can benefit from, even if there does need to be greater transparency and accountability. As to whether they merely help the rich get richer, their vast collection of advanced trading strategies and assets don't always equate to performance, and the risks involved are likely to deter your everyday investor from following suit. So there you have it. Thanks for watching. Hopefully we've answered a few of your questions on hedge funds, and we've been able to shed some light on what hedge funds actually do. If you want to find out more about investing and for more content like this, don't forget to hit the like button and subscribe to the channel, and we'll see you in the next video.